Welcome, everyone. For those of you that don't know, my name is Wolf. Those of you that do, thanks for checking me out again. Like always, this content's for educational, informational, and entertainment purposes only. If you're looking for financial advice, seek the help of a financial advisor. I'm not a financial advisor, just a dude on the internet. Don't forget to check out the free content on the site, everytimeicash.com. Or if you're looking for a subscription or community to join to help with your trading, we have that as well. Lastly, we got earnings packs on the site and other resources that you can learn from. Please don't forget to check that out as well. I'm going to jump right into it today. Powell stalled the bulls today. First things first, it's important to set the stage. Going into today, we had an 85% chance of 25 basis point hike. Historically speaking, there's never been a time where the Fed watch tool prices in more than 80% and the Fed does not follow what the watch tool is predicting. Today, we're going to talk about the Federal Reserve's recent decision to raise interest rates by a quarter point, and we're going to talk about the implications for the economy and the future of monetary policy and what's going to happen next, basically. And our key focus will be on the factors that influence the decision, as well as what we can expect in the coming months on the back of this decision. First things first, economic activity, inflation, and the labor markets. The Fed spoke and noted that economic activity actually expanded modestly in the first quarter with robust job gains, despite all of the tech layoff headlines that we saw, and a low unemployment rate. That said, they were very adamant to say that inflation remained elevated, which is a key concern for them. And it's important for us to remember that those 2 points are what make up the Fed's dual mandate. Remember, the Fed needs to achieve maximum employment while getting inflation down to 2%. That is their goal. This brings us to their decision. The Fed funds rate increase. In response to the economic conditions we just talked about, the Fed decided to raise their target range for the Fed funds rate by 25 basis points, and that brought it to a range of 5 to 5.25. The Fed continued to stress that this decision was made with the goal of achieving maximum employment and getting inflation rate of 2% over the long run, which is what we just mentioned. Now that they've gotten the rate to 5.25, the committee has to monitor and assess what's going on. The Federal Reserve Committee will closely monitor incoming information and assess the implications for their monetary policy. They're prepared to adjust their policy stance if risks emerge that could impede the attainment of their goals. And so they have to take into account a wide range of information, including labor, market conditions, inflation pressures, and financial developments, as well as like stress in the economy, and decide whether or not the course of action that they're taking is accommodative to those situations or if they're, expounding on those situations. And so as long as things stay the way they are, they plan on continuing to reduce their holdings. The committee will continue to reduce their holdings in Treasury securities, agency debt, and agency mortgage-backed securities as a part of their previously announced plans. And this is in line with the committee's strong commitment to returning inflation to their 2% objective. Once again, remember, liquidity equals markets. So as long as they don't push it too far, and liquidity dries up as quickly as it dried up in the last year, markets can kind of adjust to what it is that they're doing. When things have to stress or accelerate at a faster pace than people expected, that's where you start to have these log jams. With that said, it was a unanimous decision. The FOMC unanimously voted to raise the target range for Fed funds. We went over it at the beginning. There was an 85% chance that this was going to happen, and it happened. It was a unanimous decision, and this decision was made with recognition of elevated inflation levels, maximum employment, and the resilience of the U.S. banking system gave them the green light to do it. Powell specifically himself mentioned some of these factors, and Powell supports the 25 basis point hike. He noted strong support for the 25 basis point increase at the May meeting, and he stated that they were closer to the end of the tightening cycle. That's important. He said they were closer to the end of the tightening cycle than the beginning. He kind of gave us a carrot there. Then the committee will continue to assess the tightening through various channels as a part of their ongoing evaluation. He did not dismiss taking action if necessary. But he did say that we're kind of like closer to the ninth inning than we are the first. Of course, when you say that you support something and that you're closer to the end, you're going to get questions about cutting rates. So Powell indicated that they would not be appropriate to cut rates if the inflation forecast is broadly correct. He went on to say that like the FOMC has a broad forecast and he sees things going the way that they predict, and as long as they stay going down that path, that it would not be appropriate for the Fed to cut. The committee believes that inflation will not come down quickly. That is a part of that forecast that he talked about. And thus, if it doesn't come down quickly, it would not be suitable for the Fed's response to be cutting rates. This is kind of in line with some of the thinking that I've had, but I'm going to table that for now. Powell continued on credit tightening in small and mid-sized banks. He says that he and the Fed emphasize the focus on credit tightening for small and medium-sized banks, and that's a concern. This is something that they've had to be more vocal about on the back of the Silicon Valley Bank and on the back of some of the stuff that happened after hours today. The committee will closely monitor credit standards and ensure financial stability to help support economic growth. He mentioned that some of the credit crunch is making it more difficult to raise. And he basically is saying that like the system is kind of taking care of itself to some degree, but they don't want to push it too far. And so if you just think of it as like a car that's kind of like a car that will overheat if you rev the engine too much, sure, you can kind of play with that a little bit, but if you go too far, you run the risk of actually stalling the car out or breaking down. In line with that breakdown, there's a recession possibility. Powell stated the possibility of avoiding a recession is more likely than experiencing one. So I gave you a little bit of clickbait there with the recession possibility because that's basically what media and social media and all the headlines will probably say at some point, but it's important to actually read and listen to what he said. He said the possibility of avoiding a recession is more likely than experiencing one. So, but he cannot rule out a mild recession. The Fed will continue to monitor that situation and economic indicators and adjust their policy as needed to mitigate these risks. This is important to me because he actually said the recession word, and he actually said that it's possible. It's also important to me because, as we know, the Fed's been wildly incorrect with how they predict things. And so we know from the last 2 years that a lot of times they say something and it doesn't actually happen, and the opposite actually happens. So it'll be interesting to see how this thing materializes and whether or not they'll react quickly enough or if they'll be too slow in their reaction. Of course, one of the things that could create the recession is inflation. So Powell reaffirmed the Fed's commitment to their 2% target. And when he was pushed on it a little bit, like if you've heard me before, I've always said that they're going to stay the course and they're not going to pivot as people expect until one of two things happens. Either they realize that there's a structural inflation problem and inflation stubbornly persists at a level, let's say 3% in this case, for some time, and they can't actually push it down lower, or something breaks. That's always been my base case, and he basically kind of poo-pooed that when he was pressed on it by a reporter. He basically said that their goal is not to say, okay, we got to 3%, we can't go any farther, and their goal is to actually reach the 2% inflation target, and this process might not be smooth or swift, and they're going to stay it until the job is done. But if we just go back for a second and we remember what he said on this slide, where Powell started talking about credit tightening in small and mid-sized banks, he explicitly said that some of the credit crunch is making it more difficult to raise. So, he's going to probably come to rubber meet the road point if you get to a point where you get to 3% and inflation stubbornly sticks there, but everything else kind of gets tied up or log jammed, and he has to make some sort of action because something broke. So that's the part that I think is most interesting in this statement, and that's the part I'll be monitoring myself. But he did say today that they're going to push it until it gets to 2%. And on the back of that, let's highlight the importance of communication. The Fed recognizes the importance of clear communication, transparency, and predictability in monetary policy, which is kind of weird because there's nothing that's transparent or predictable with how they're saying things, except when there's a blackout period. So we spent like an hour today playing Words with Friends with Powell, trying to figure out what it was that the Fed was saying, what he was saying. So it's interesting that they are so adamant to go out of their way to tell you that they highlight the importance of communication. The second part that's interesting is that they plan to give regular updates and assessments on their plans. And that's interesting because sometimes, as we've seen, they talk too much. And when the Fed talks too much, it gives you an instance where you have more communication than you need, and it creates less clarity, not more. So that's kind of my takeaway on this, and that's something that I'll be monitoring in the next couple of weeks and months. Let's wrap a bow on this. Here's our takeaways. In brief, I'm going to leave this up for you so you can read it. But in brief, the totality of today's decision wasn't as market friendly as the market hoped it would be. The main takeaway for me is that even if the Fed does pause its rate hikes, the Fed isn't inclined to pivot to a cut, which is what most people expect, anytime soon based on the current outlook of the economy. And so, generally speaking, for the better part of a year now, I've been hearing pivot, and you've got rate cuts pricing in at the back end of the year and into 2024. But again, from my experience and from things I've seen in the past, generally speaking, they don't pivot until something breaks, and generally something breaks because they pushed it too far, or they pivot when they have to react to something that they didn't plan for. And so that's kind of been my base case, and that's kind of going to be where I'll stay. With that, I want to say thanks for watching. Thanks for your time. And don't forget to like and subscribe. And with that, please stay safe. Please stay profitable. And as always, stay locked in.